There are so many headlines right now, whether it's housing, politics, but I'm here to break something down for you today. And I'm talking about the housing issue, affordability, what the government is trying to do with Fannie and Freddie buying $200 billion worth of mortgage-backed securities. Is that going to impact us? You may have seen the headlines this week saying that mortgage rates dropped after the administration directed Fannie and Freddie to buy $200 billion of mortgage-backed securities. The implication is simple. Government steps in, rates go down, housing becomes more affordable. It sounds great, except that's not how this actually works. So today on this Econ 101 session, it's about buying mortgages and how it doesn't actually fix anything, especially in regards to affordability. And why most policy solutions keep treating the symptoms instead of the causes. If you're a home buyer, this one's for you. If you're a homeowner or investor, this one's for you. This matters a lot more than the headline suggests. So without further ado, come on in. I think this is important because it takes us beyond the headlines. What is actually happened? What was announced? So the administration directed Fannie and Freddie to purchase $200 billion of agency mortgage-backed securities. Now, I see your eyes rolling back like, oh, here we go with all the alphabet soup. I get it. But after this announcement, the average 30-year fixed-rate mortgage dipped a little bit to roughly about 6.08%, the lowest level since 2022, according to Freddie Mac. The stated goal is to pressure mortgage rates lower and stimulate affordability. But according to a recent JP Morgan analysis, this move only compresses mortgage spreads slightly and is unlikely to deliver any meaningful step change lower in mortgage rates. So in other words, optics look good, impact is actually limited. So Econ 101, what actually drives mortgage rates? So let's strip this down to the basics. I'm going to do this in layman's terms because I know it gets very, very complicated when people start talking about it, when they start talking about it really, really quickly on those CNBC and Fox News and all those other things. So mortgage rates, they're driven by three things: the 10-year treasury yield, inflation expectations, term premium, and risk compensation. Now, importantly, inflation expectations. Bond vigilantes in the market price in what they think they want to purchase 10-year treasuries at. Now, if they are disinclined to purchase those 10-year rates, yields move higher because, as you can see, we have a lot of money going into the market. And if people place a higher risk of default on you repaying that debt, they're going to want a higher yield to be given to them for the level of risk. So according to JP Morgan, the 10-year yield is the foundation. It's the building block for mortgage pricing, and those fundamental drivers show limited room for rates to fall materially. So in layman's terms, even if you manipulate the bond market slightly, you're still anchored to the broader rate environment. Like I said, if I feel like you have a higher risk of default, I'm more inclined to sell your bonds because I want a higher risk premium attached to it. I don't want the 4.2% that I'm getting in the 10-year treasury. I want something closer to a 5 because I don't trust that you're going to be able to repay your $38 trillion worth of debt. So again, you can't cheat math. You can't override capital markets with press releases. It's important to understand that there's drivers to these things. It's a capital market. Buyers and sellers, people, countries are willing to buy your debt only if they believe you have the capacity in which to pay off those debts. And if they feel like you don't, they're going to require a higher risk premium or a higher compensation for the debt they're choosing to buy. So let's get a little technical, but I'm going to keep this in layman's terms. So what are mortgage spreads in plain English? Mortgage rates aren't just treasury yields. They're not just treasury yields plus treasuries plus a random number. They include something called a mortgage spread. The two main components of mortgage spread, the primary secondary spread, which means that basically makes up lender cost, profit, servicing, origination capacity. The secondary spread, investor compensation for prepayment risk and credit risk. Think about secondary spread as if I'm a credit card company and I need to be compensated for the level of risk or the amount of money that I'm going to lend you, I'm going to give you an interest rate. So you have to be compensated for the level of risk you're willing to take, giving the prepayment risk and or credit risk, which is the default risk on an individual. So JP Morgan has already said that spreads have already tightened significantly, which means that the spread between something that's investment grade to the spread in something that's high yield meaning something that has a higher default risk, have already compressed. So there's very little spread there. The gains have already, there's very limited room for those to compress even further. So in plain English, the gains from the spreads have already been made. So if the housing market thaws even slightly and more people refinance or originate mortgages, capacity constraints can actually push spreads wider, not narrower. So right now we have narrow spreads. It's tight. It's going to press them. It's going to push them wider. So the policy could partially cancel itself out. So why this policy is mostly, or I feel it's mostly symbolic. Here's another piece that the headlines typically ignore. The Federal Reserve is still shrinking its own mortgage-backed securities holdings by roughly $15 billion per month, which essentially offsets a chunk of what Fannie and Freddie are buying. So think about like we're shrinking our balance sheet, but now we're going to do this over here. So the net boost to the mortgage market may be far smaller than the headline numbers suggest. This is why I keep saying policymakers love announcing big numbers, but markets care more about net effects, not political theater. So why lower rates don't fix the affordability problem? Even if this did push rates down modestly, let's say 20 to 30 basis points, that doesn't solve the affordability problem. Affordability is driven by home prices, first and foremost, taxes and insurance, which are actually going up, supply constraints, which we haven't put enough supply on the market, household balance sheets, which are getting better in this K-shaped economy. A lot of it's getting better. Wage growth and wage growth relative to asset inflation, which again, we have some wage growth, but we have housing prices and things moving up just in the same cohort, which is offsetting that wage growth. So lower rates simply increase purchasing power, which often pushes what? Prices higher again. That's how you get stuck in this feedback loop. Stimulus plus higher demand plus higher prices lead to affordability still being broken. You're treating a fever with ice packs instead of addressing the infection. So if we're just treating the symptoms, what are some of the risk and unintended consequences? JP raises legitimate questions around risk management for Fannie and Freddie, capital usage, hedging capacity, earnings volatility, especially while policymakers are debating their future structure. They don't know if they want to take it public or keep it private. Translation, you're shifting the risk around the system without solving the underlying problems. We've seen this movie before in different forms. So here are my key takeaways. For buyers, don't expect policy headlines to suddenly make homes more affordable. If you're waiting on a miracle rate drop, you will be waiting a long time. For homeowners, small rate dips don't change refinancing math meaningfully for most households. So for most of us who have sub threes or sub fours, you're good where you're at. In my humble opinion, a lot of that's free money, especially when you can get a risk-free rate in the threes and the fours as well. Hey, your house is being paid for. For investors, Policy intervention creates volatility, not clarity. Fundamentals still win the long term. So in closing, housing affordability won't be fixed by financial engineering. It will be fixed by time, supply, pricing discipline, and real wage growth, not by bond purchases. That's my Econ 101. Thank you guys for listening. I hope this has been a valuable use of your time. I'm here to educate, empower, and engage, and also entertain. Thank you once again. Until next time.